This morning we had the weekly unemployment insurance claims released and the CPI. What we saw from the CPI was that inflation actually declined by 0.3%, largely related to a decline in energy prices. And the weekly unemployment insurance claims indicate that the labor market is moderating. They went up by about 6,000, not a big increase, but nevertheless it suggests that we're unlikely to see an acceleration in job growth over the next few months. I think what it means for the broader economy is first we have to look at the consumption numbers very carefully to keep in mind that consumer prices are falling, mainly in energy, but you could have retail sales decline slightly or stay flat, and it would translate into a real increase in the GDP accounts. So that's kind of a nuance that a lot of people aren't talking about. Also, it provides an opportunity for the Fed to move with some new round of quantitative easing if it chose to, because inflation is not bubbling, and there are some indications that even service prices are beginning to moderate. The core index was still up about 2.3% year over year. The Fed would like to see it at around 2%, but there's no signs that inflation is accelerating. And I think it suggests that the broader economy is still growing in the United States, but we're seeing very modest growth, probably in the 2 to 2.5% range. I think the latest numbers on the CPI would indicate that it makes it easier for the Fed in their narrative as to why they eased. It gives them the opportunity to use this as a reason for easing. They would not ease just because the consumer price numbers went down, but it gives them some narrative to be able to do so. And they will look at the real economy, they'll look at employment growth, and whether or not the unemployment rate continues to tick up. If the unemployment rate continues to tick up over the next few months, then the Fed will probably announce that they're either going to buy mortgage-backed securities directly. I don't think they're going to get much more from buying long-term bonds when you get a 10-year yield at 1.6% or so. Unlikely to get much out of that. I think the financial markets would view the Fed easing as giving a psychological boost to remind folks that the Fed's still out there. They still have some ammunition. The ammunition isn't as powerful as it used to be, but the Fed still does have the ammunition, the powder keg essentially. Well, of course, the United States is closely linked to the Eurozone, although not as closely linked as we used to be. 30 years ago, our trade was much more important with Europe, our exports going there. Today, less than 20% of our exports go to Europe, so a 10% decline in exports to Europe from the U.S. Would translate into about a 2% decline in our overall exports, which would take about 0.2% off of GDP growth. But of course, there are much broader linkages than just the direct trade linkages with Europe. There's the financial contagion. Money market wholesale financial funds could dry up. That's a much broader contagion question. And as you have signs of further weakness in Asia emerging, especially China and even India, it's harder to see exports being a source of growth for the U.S. as they have been over the past 2 or 3 years. I still think we'll see export growth in the U.S., but it's not going to be at the same rate that it was. I think that the media has been looking at the latest kind of retail consumption numbers and viewing them in a negative manner, in the sense that retail sales for the month of May reported a decline, but it was because gasoline purchases were down, and that was due to a decline in gasoline prices. So the media has just been reporting, to a large extent, the top line numbers and not adjusting for the inflation difference, the fact that those prices are falling. And what that says is that while consumer spending isn't skyrocketing upward, it's not actually declining. And when you combine that with lower gasoline and oil prices and even natural gas prices, it leaves a lot more discretionary income to purchase other goods and services that would have had to have gone to gasoline.